Recap. I'm Daniel.
And I'm Mira.
Imagine a classic high-stakes tug-of-war. Like, on one side of the rope, you have this relentless, almost unstoppable momentum of the AI infrastructure cycle.
Right.
Just pulling us forward.
Yeah, but then on the other side, you've got the dead weight of geopolitical energy shocks and, surging interest rates just pulling back with everything they've got.
Exactly. And right now, those macro forces are really digging in their heels. They're dragging that entire AI narrative straight through the mud. So welcome to the deep dive.
The tension out there today is it's palpable. The market is desperately trying to balance this incredible generational technological leap against some very rigid traditional economic constraints.
And spoiler alert, gravity won today.
It definitely did.
Let's look at the damage. Just to quickly summarize the tape for Tuesday, May 19, 2026. U.S. equities retreated alongside a rapidly strengthening dollar and rising treasury yields.
Right.
That benchmark 10-year note, it climbed to a punishing 4.667%. The S&P 500 cash index closed down at 7,353.61.
While WTI crude oil just completely bucked the risk-off trend, surging to peak at $104.65 a barrel.
Which, that perfectly illustrates the tug-of-war we just mentioned. Stocks down, yields, and oil up.
Yeah, completely.
So, here's your roadmap for today. We're going to unpack the massive overnight global setup, explore the fraught geopolitical negotiations that dominated the U.S. session, and look at how corporate AI hardware rollouts violently collided with that macro reality.
I'll also cap things off with our bonus paper trading segment later on.
But first, a quick reminder before we jump into the deep end. This deep dive is purely for market context and discussion rightware. It is not personal investment advice or a recommendation to buy or sell any assets.
Definitely not.
So, session one. What set the stage before the U.S. session today? Because to understand the U.S. trading hours, we really have to look at the global setup late Monday, May 18 Eastern Time.
Right. That's when we saw this highly coordinated wave of Ukrainian drone assaults.
Yeah.
They struck critical Russian oil refineries, specifically the major facilities at Ryazan and Yaroslavl.
Oh, wow.
Yeah. And these strikes effectively halted major operations at those plants. And the distinction here between a refinery and an oil field is vital for you to understand.
Because it's not just crude sitting in the ground, right?
Exactly. When you hit a refinery, you're immediately choking off the supply of refined products, things like diesel, jet fuel, gasoline.
And that creates a very immediate physical bottleneck, which, lands right on top of a stark warning we just got from the International Energy Agency.
Yeah, for TV roll.
Right, the IEA chief. He pointed out that commercial oil inventories are depleting so rapidly that some regions literally only have weeks of cover left.
Which is wild. The IEA is highlighting this massive perception gap between physical oil markets and futures pricing. Yes, strategic petroleum reserve releases have added about 2.5 million barrels per day to the market.
But those emergency buffers are finite.
Exactly. You can't just infinitely drain the SPR.
And as we've discussed on the show before, this physically constrained energy market, it essentially functions as an energy shock, as delayed consumer tax.
Yeah, that's a great way to put it.
When crude spikes to $104 a barrel, it acts as this stealth tax, right? It slowly drains discretionary income from consumers. It doesn't go to a government. It just vanishes from the broader economy.
And we are seeing major structural reactions to this reality in Asia right now. Japanese Prime Minister Takaichi and South Korean President Lee, they just agreed to new liquefied natural gas and petroleum swap arrangements.
They're structurally rearranging their supply chains because they see the writing on the wall.
They do. And this physical oil bottleneck immediately bleeds into global inflation data, which brings us to the central banks. Late Monday Eastern Time, the Reserve Bank of Australia issued a really stark warning.
What did they say?
Basically that companies in their region are rapidly passing these soaring input costs directly onto consumers.
Wow. And Europe echoed that exact panic on Tuesday morning. We had multiple European central bank officials, Villeroy, Nagel, and Kocher, all publicly signaling a potential June rate hike.
Directly because of the Iran conflict and that subsequent energy supply shock.
Right. They are out in full force defending their central bank credibility as an inflation anchor. But, Mira, I actually have to push back a bit on the ECB narrative here.
Okay, let's hear it.
Are they really just fighting domestic energy inflation? Because if we look at this through a game theoretic lens, isn't it highly likely the ECB is just terrified of the currency defense as Treasury sell-off feedback loop?
Oh, that's interesting. Unpack that a bit for the listener.
Well, with U.S. yields spiking to 4.667%, the dollar gets incredibly strong. If the ECB decides to cut rates while the U.S. holds or hikes, the euro just collapses against the dollar.
Right, and since oil is priced in dollars.
Exactly. A weak euro means Europe imports even more inflation. So aren't they basically forced to threaten rate hikes just to keep pace with the U.S., regardless of what's happening in their domestic economy?
That is a brilliant distinction, Daniel. The ECB is absolutely trapped by the gravitational pull of U.S. Treasury yields.
Yeah.
It's rarely just one isolated variable.
Yeah.
Yes, they face a genuine supply-side energy shock, but you're right, if they diverge too far from the Federal Reserve, they trigger this vicious cycle that essentially imports U.S. monetary policy right into Europe.
So that hawkish shockwave overnight perfectly set the stage for a massive collision. Let's take a quick breath and transition into the next part of the day.
Sounds good. Session 2. What moved markets during U.S. trading hours today?
The entire U.S. session was just dominated by these fraught back-channel negotiations regarding the blockade in the Strait of Hormuz.
And the political signals the market had to digest were incredibly conflicting. I mean, on Tuesday afternoon, President Trump suggested that a deal could happen in 2 to 3 days.
Right.
He noted he was waiting on Iran and that Gulf states and Israel were involved in the process.
But then, practically in the same breath, Vice President Vance took a much firmer, more hawkish stance. He publicly emphasized that option B, which he explicitly defined as restarting the military campaign, remains a very active alternative if negotiations stall.
It's a classic geopolitical escalation as brinkmanship game theory scenario. Both sides are inching closer to the edge, just seeing who blinks first.
Yeah.
And that is a recipe for massive market uncertainty. We also saw this play out in the financial theater. Tuesday morning, around 9:20 a.m. Eastern Time, U.S. Treasury Secretary Scott Bessent delivered a major speech.
Urging European and Asian allies to aggressively target Iranian financiers, right?
Exactly. And to unmask their shadow banking networks.
Which, I mean, tracking shadow banking is notoriously difficult. It's not just sanctioning a state bank. It involves hunting down layered transactions and shell companies outside the traditional SWIFT system. It's basically financial guerrilla warfare.
It really is.
Yeah.
And while all this talk of truces and financial warfare was happening, we actually got a very concrete physical catalyst during the session. The U.S. seized an Iran-linked oil tanker in the Indian Ocean.
Which proves the conflict is actively disrupting shipping lanes as we speak. So we have this geopolitical stickiness keeping oil prices elevated.
Yeah.
But I want to connect the dots for the listener here. If I'm holding a portfolio of AI and tech stocks, why does a seized oil tanker in the Indian Ocean make my Microsoft shares drop today?
It all comes down to the discount rate acting as financial gravity.
Yeah,
We've touched on this concept before, but it's crucial today.
definitely.
When oil stays high, inflation fears rise, which pushes the 10-year Treasury yield up to that 4.667% level we saw.
Right, and how does that 4.6% yield physically drag down equity valuations? Like mechanically?
Think of equity valuations, especially for high-growth tech companies, as a hot air balloon. The discount rate is the gravity pulling it down.
Okay, I like that visual.
Investors buy tech stocks for the massive cash flows they expect to see 5 or 10 years in the future. But if you can suddenly get a guaranteed risk-free return of over 4.6% from the U.S. government today.
Right, those future profits look less appealing.
Exactly. Those risky tech profits become significantly less attractive in today's dollars. So mechanically, even if a company's underlying business is completely flawless, its stock price has to adjust downward to compensate for that higher risk-free rate.
It is pure financial physics. Higher yields mechanically drag down valuations. And that dynamic brings us straight into the corporate events. Let's pivot slightly. Session 3. Corporate events recap and what to watch next.
Because despite that heavy, restrictive macro environment, the micro-level updates prove that the AI CapEx cycle, this cycle-agnostic arms race, is still firing on all cylinders.
It really was a split-screen day. Google held massive events on Tuesday, May 19. They rolled out the Gemini Omni AI model, Gemini 3.5, and a new 24/7 AI assistant called Gemini Spark.
But the hardware announcement was the real standout for me. Google announced a massive joint venture with Blackstone to provide technology for a brand new TPU tensor processing unit cloud infrastructure.
Which is huge.
Yeah. This isn't just software. This is physical, concrete investment in immense compute power, funded by private equity. Alphabet and Blackstone actually saw a nice bump in the pre-market off that news.
And Microsoft wasn't sitting on the sidelines either. Tuesday morning at 9:21 a.m. Eastern Time, they launched their new Surface for business devices. These run on Intel Core Ultra Series 3 processors.
What's critical here is their strategy of pushing AI acceleration directly to the edge.
Right, meaning they are processing AI tasks locally on the physical device in your hand rather than bouncing every single query back and forth to a massive cloud server.
Which is a huge architectural shift. It reduces latency, it cuts cloud compute costs, and it enhances privacy.
Huge. And as a quick side note on architectural shifts, but in financial plumbing, a Bloomberg report indicated the SEC is preparing an innovation exemption framework for tokenized stock trading.
Oh, right. That could eventually allow third-party digital stock tokens to trade on crypto platforms, potentially enabling 24/7 trading outside traditional clearinghouses.
It's an interesting structural evolution, though. It didn't really move the broader needle today.
It didn't, because the macro forces were simply too overwhelming. This is where we see that fascinating clash. Despite these multi-billion-dollar product launches and massive technological leaps, Microsoft closed down 1.44% on Tuesday.
And the broader technology sector ETF, XLK, fell 0.64%.
It perfectly illustrates duration risk as tech multiple compression. As we explained earlier with the hot air balloon, the cash flows for these AI investments are years away, making them hypersensitive to interest rates.
So today, macro narratives blinding micro-resilience was the absolute dominant theme. It did not matter how revolutionary Google's new AI model was. With the 10-year yield spiking, valuations took a hit.
It's the kind of tape that generates a lot of gallows humor on the trading floor.
Yeah. Honestly, today was the kind of day that makes you wish you had Google's new 24/7 Gemini Spark Assistant just to handle your portfolio panic.
No kidding.
I mean, fund managers threw their cash into equities right before yields spiked, and we've got blockaded straits and European central bankers threatening hikes, yet tech companies think a new AI-powered business tablet is going to save us.
Right.
On the bright side, with the SEC's new framework, soon you might be able to watch your portfolio drop on the blockchain instead. Hang in there, and we'll see if the hyperscalers can finally train an AI to lower interest rates.
If they manage that, I'll buy the enterprise subscription myself.
Fair enough. So, looking ahead, what should you be watching next for Wednesday, May 20? The data docket is packed. At 7 a.m. Eastern Time, we get MBA mortgage applications.
And at 10 a.m. ET, the NAHB Housing Market Index drops.
Then at 10:30 a.m. ET, we'll see the EIA crude oil stocks. Given the IEA's warning today about rapidly depleting inventories, every barrel in this report is going to be heavily scrutinized.
We also have Treasury bill auctions at 11:30 a.m. ET, and finally at 4 p.m. ET, the Treasury International Capital, or TIX flows.
Those TIX flows are absolutely crucial right now. With yields at 4.667%, we need to see if foreign buyers are still willing to step up and absorb U.S. debt, or if that demand is starting to crack.
So keep it. Eye on all of that. Okay, we are now moving into our bonus on-air session, paper trading.
For those newer to the deep dive, we started a public paper trading experiment internally back on April 17th. We took a hypothetical $10,000 and spread it across 13 macro ETFs just to see if we can generate some alpha from our daily analysis.
And it is working so far. As of the May 19 close, the portfolio value is sitting at $10,927.29.
That is a 9.27% return, which is solidly outperforming the S&P 500's 3.19% return over that exact same window.
Our logic is holding up.
Oh.
So let's debate the adjustments we are making at the close of the next trading date, Wednesday, May 20. What's your view on the current allocation?
My view is heavily influenced by that 4.667% yield on the 10-year. I want to aggressively reduce our duration risk because tech multiples are going to keep compressing if rates stay this high. So I'm proposing we sell $1,000 of our XLK position. That's our core technology sector ETF. To offset that, I originally wanted to buy $800 of XLE, the energy sector ETF, to actively hedge against this ongoing inflation and physical oil shock.
Right.
And I wanted to tuck the remaining $200 into XLV healthcare, just for a little defensive ballast. What's your take on that move?
Well, I completely agree with you on selling the XLK and buying the XLE. An energy hedge feels non-negotiable in this geopolitical climate. But I am going to challenge you on dumping all that tech capital.
Oh.
Yeah, instead of the heavy healthcare defense, I want to add $500 of the communication services ETF.
That's interesting. Why rotate into communications instead of just reducing our overall tech footprint?
Because dumping all tech entirely ignores the micro-resilience we just spent the whole show talking about. AI software and cloud infrastructure are still booming. Look at the Google and Blackstone joint venture today. XLC captures the software, communications, and cloud side of the AI CapEx cycle. Those businesses have more immediate cash flows and subscription models, making them highly resilient.
I see.
By moving from XLK to XLC, we avoid the pure hardware duration risk, the expensive semiconductor and server plays that take years to pay off while still capturing the software upside. We shouldn't abandon AI. We just need to shift where in the tech stack we hold it.
That is a phenomenal pivot. It sheds the hardware rate sensitivity while keeping us exposed to the software cash flow. I love it. So let's compromise and state the final aggregated trades to be executed at the May 20 close.
Let's hear it.
We are going to buy $250 of XLC, which will make up 2.3% of the portfolio. We will buy $650 of XLE, adding a 5.9% energy hedge.
Got it.
We will sell $1,000 of XLK, reducing our hardware tech weight by 9.2%. And we'll buy $100 of XLV for a minor 0.9% defensive bump.
Perfect. And as a final reminder to you listening, this is a live educational experiment and not financial advice. Past performance does not guarantee future returns, so please do not copy these trades.
We're just putting our analysis to the test to see how the mechanics play out in real time.
And that brings us to the end of today's deep dive. If we zoom all the way back out to that tug of war we started with, the rope is only getting tighter.
It really is. So we leave you with this to mull over. Do you believe the sheer historical technological momentum of the AI infrastructure boom can ultimately outrun a physical global energy crisis? Or is financial gravity finally going to pull this market back down to earth? Let us know your thoughts in the comments.